All right, everyone. Welcome again to another business roundtable by Exit Your Way. Just had a brain fart there. Today we're going to be talking about how to buy a business. It's awesome to have you all here. We're lucky because we get to work with awesome people like Lisa Forrest here with Live Oak Bank. She's an SBA banker. She helps people fund the purchase of businesses. So we're going to be talking a little bit about the process of buying a business. And then Lisa's going to explain, what it's like to do SBA, do an SBA loan to buy a business. It's like she said when we were getting on, it's something she does every day, all day, is explain to people what SBA loans are and how they work and all that good stuff. Then we're going to have Andrew talk a bit about, the overall process of buying the business and some of the things that people can get either should be doing, need to be doing, could think about, those kind of things. And we're going to end up today. We're going to try to end up today about 8:45 and be done by 9. We're moving our format from what was a couple hours down to an hour and a half to trim this up. And just want to make sure that everyone's aware of that. So we're going to finish about 8:45, do some additional networking so you can ask Lisa questions or us any other questions. And I also want to say, too, if you get onto the topic like this and you need some additional information, feel free to reach out to myself, Andrew, or Lisa for more, and we'll do that. So, Andrew, what do you got going for us today?
Yeah. Hey, no, this is, of course, one of my favorite topics, but I spend, a lot of time. So we're talking about the sell side, the buying a business and the challenges of that, too. Now, we work at Exit Your Way. We work with sellers, almost exclusively. But with that said, we, in order to make a deal successful, we have to work a lot with buyers too on the other side about how to buy a business, and help them, and it's not that we represent them, but helping them, be successful in a transaction, because it's hard. It's really hard to buy a business for every 20 people that decide, I want to buy a business, I want to own my own business, and buying a business is a great way, to get into business. It's less risk than starting a business, for sure. The numbers on that are proven. If you have something that's already established and you have the wherewithal and the experience to do it. But for every 20 people that go out to do it, maybe one actually successfully, gets a transaction done. And, that's sort of what we're here today, a little bit about talking about that. And we spend a lot of time working with our clients who are selling businesses to prepare and get ready to sell a business. Well, the same has to be done on the buy side. And so often of the 20, even with good intentions, you may even have the money to do it or are financially capable. You're still going to fall down if you don't, present yourself properly or do all the preparation work to get a deal. Because it's, I think too, in a way, it's compare it to a very competitive real estate market. You're not going to get a house bought in these competitive markets unless you have your money ready to pull the trigger, ready to do your evaluation and go in and put an offer in day one, because it's competitive. And that's the way it is today. Not that there are a lot of businesses that don't get sold, but the ones that do get sold, they don't last long, and people are in there going after them. So it takes a little bit. We're going to talk a little bit about that today, about how to be successful in buying a business.
Yeah. Well, Lisa, it's awesome to have you here today. We'll come around to the SBA stuff. You've been doing this a while now, and
remind me.
Well, I know we've all have, but just to put it in perspective, how many SBA loans are you closing in a year? Live Oak or you, or just as?
Well, so Live Oak, we're the nation's #1 SBA lender, and I know there's people on this feed that might not know who we are or have heard of us, because what we do is we finance business acquisition across 25 different verticals. We're a virtual bank, so we don't have branches. But if you're doing an M&A transaction and you need senior SBA debt, then you absolutely get to know us very, very well. So we're the nation's #1 SBA lender. I'll put it in perspective. This month in September, because of the SBA stimulus on getting the no 6 months of P&I as part of the last stimulus package, like put it in context. I mean, we're going to close probably 600 loans this month, Live Oak Bank, this month.
Yeah.
So, and then I'm a 33-year veteran of this, and I could close anywhere between kind of 30, maybe 30 loans a year.
Yeah.
Kind of depending. So been doing it a long time, and I focus specifically on M&A, buyer financing. SBA, I know for those of you new, maybe this is your first acquisition, you've never bought a business and you've never used financing outside of maybe financing your house, which has up to this point probably been the biggest financial transaction you've encountered. It could sound a little daunting, and I know there's some maybe a little bit of bad reputation about using SBA, but it's a terrific tool to acquire a business. And the key is to work with a lender, and this is not a commercial about Live Oak. There are lots of great lenders out there. We're very blessed in our Seattle greater region that we have a lot of great M&A lenders. You just really want to work with a lender that specifically does M&A transactions.
Yeah, that is one thing that we run into.
And I think, with that, too, is people need to understand, too, and we do this on the sell side because, yes, it's a daunting process because SBA is a government, supported thing. So with that, there's a lot of paperwork. There's a lot of steps you have to go through it and check things off. That's part of the preparation aspect of it from the buy side, but also from the sell side. It is the cheapest money you can get. Even people, buyers who come in to me and say, I'm going to pay all cash, I'm skeptical about that because it really just doesn't make sense. You need to kind of go through the process and use these. So why would you use, all your cash to buy something when you can lever it at, a 5.5% or 6%? Money is cheap now. Yeah. And, at the end, we can go through this process with the cash. And I've done that with buyers who say they want to pay cash. They'll end up changing their minds because, it just may take them a little while to figure out that really doesn't make sense.
Yeah.
So part of that, that process is understanding what SBA does. But as business owners on this side, there's a lot of folks on the table here are business owners. Some of them are solopreneurs, and they, I wanted to talk a little bit about that, Lisa, too. They may not think that there's a market for their businesses, but there actually is. I mean, you think of the banks as supporting, without hard assets like real estate or tangible assets, but if there is cash flow in a business, there's value. You want to talk a little bit about that, Lisa?
Sure. And the benefit of the SBA transaction, and my segue was that there's a kind of a reputation maybe about the SBA, but it's a great program. And, it doesn't have to be excruciating. It can actually be a really fulfilling process for the seller who's, exiting and creating their wealth. And obviously the wealth generation capabilities for the buyer coming in. So it can actually be a really fulfilling transaction for everybody involved. So the thing about the SBA that really makes it well suited is that because of the longer term, you get a 10-year term versus conventional, maybe a 5-year term. You can really afford a lot more loan because of the term. And the purpose of the SBA loan, because the Small Business Administration is, in theory, guaranteeing 75% of that loan for the lender is compelled to be maybe more aggressive or more friendly to an asset transaction. We're definitely cash flow lenders. Now, you really got to make sure you're working with an SBA M&A lender because sometimes some lenders still want that collateral, but the SBA program is well set up under the 7A program to do asset-light cash flow transactions.
Yeah.
When you've got a 10-year term, asset-light, we're gonna take your house if you have it, but we're not looking for a certain loan to value. It can afford a really nice amount of loan. And because we are looking at historic debt service coverage, one of the governors on this in the lower middle market is that the multiples are still in check. It's a reasonable multiple for the buyer, and the seller still gets to exit with a nice amount of cash and to take their retirement off the table. But it is a historic debt service based. So it's mix. It's a nice balance. You get a 10-year term so you can afford more, but we're not in that, 7, 8, 9, 10 middle market multiple. We're in that sort of 2.5 if you're, in a certain industry range, up to maybe, 4 or 5, depending on what industry you're in.
Yeah. That's cool. It's some of the details there. And we'll get into more of the SBA details. I think one of the things that we were going to cover today too is really, buying a business is not like anything you've probably tried before. And if people here have ventured down the process, as many of us have, the first thing you're gonna realize is, you need to be prepared. The search process itself can be grueling, because there's only about 25% of the businesses that are actually for sale that are listed. So how are you going to find the right businesses? And then, when you're looking, really understanding what you're qualified to buy. And I think that's a place where a lot of people don't spend the time, because if you're going to buy, if I've got experience in the construction industry, say, I shouldn't be out trying to buy dental practices. Even if I'm not going to be the dentist, even if I'm not going to be, there's different, you've got to kind of stay in your lane to a certain extent. And Lisa will spend a bit more time about that when we talk about the, industry relevance in an SBA loan. But you really need to understand where you're going to go with this, then work with your SBA lender or think about your financing situation and how you're going to fund a business, because don't go out and waste your time trying to buy businesses that are $10 million if you've got $100,000 in your bank. It's just not going to work. You have to figure out your financing package to figure out what you can do in your industry that's really relevant with something you can make, that you can run and do a good job with before you even go. And then once you get that and you understand, you start looking at businesses, I think there's a process, and I'll let you two answer this a lot better. You got to get through your initial diligence quick on these businesses, or at least have it really clarified what you're going to do, because you are going to need to look at a lot of businesses before you find the one you like. And you can waste a lot of time if you go into a deep dive on each one, only to find out that they're not right. So having your key aspects are real. And I'll stop there.
Well, I think it's know what you're looking for, and then that comes to another part about us, how you value a business. And I'm happy we want to work with buyers to help them understand that process all the time, because you're going to get a certain amount of information from a business. You need to know what you're looking for and go in there and make sure that meets the criteria so that you can move, then strike fast, successful on the deal. And part of that is not only doing your homework with your banker. The bankers, that's why even these entrepreneurs who are sitting here too are own businesses. Start talking to your banker now. Build a business to sell, because that's going to be great. They're a vast resource of information, and valuation is important. And if you can't get that from the bank as well, understand what your business is worth and understand how you properly can entertain an offer that makes sense. And a lot of it has to do not necessarily with the price. It's the terms that really is what gets a deal done too. So if you don't know how to do that as a buyer, then you need to also do your homework with that to, maybe get with a professional evaluator. You have to understand too how you're gonna be competitive in there. So many times I'm surprised that I have buyers come in and they come in and the offers are not even in the ballpark. And I don't know where, that's the problem. Buying a business is there's just not a lot of information available in this market about it. Not like buying a house where you have all the information you need. But these are privately held. They're very confidential transactions for a lot of reasons. And it's difficult for a buyer to, and again, that's part of getting ready, is gathering all that information you need.
Yeah.
And I would say, and I would say from the buy side, when I've got potential clients, prospects coming to me where they're pre-LOI and they need some assistance in how do I vet this thing, right? So especially if it's the first time they've done it. I've got a pre-LOI kind of guideline. I've got a couple of due diligence questionnaires. Like I've got a COVID questionnaire now, a due diligence questionnaire. I've got a sample cash flow. I've got some details around providing an executive summary to us. So I'm happy to send that to you, Andrew, Damon, make it available to the audience here. But that's, so when you come to me as the lender, you have to have a certain amount of your homework done in order to engage me. You have to have a certain amount of information for us to be able to have a conversation. So I've got a little bit of a roadmap that a lot of my buyers find helpful. And then I would also share that if you've got existing business owners in the room here, strategic acquisition from the standpoint of growing by acquisition, it is a great time to do that. And I would say half of my deals I'm doing right now are strategic acquisitions where you are efficiently growing, organic growth for sure. You've been doing it for years, but if you're contemplating a strategic acquisition, I am all in on that. So happy to also be contacted. If anyone needs lending for buying a second or a third or a fifth business or what have you as you grow your EBITDA.
Yeah, and that's, you know, we were just talking to a client yesterday that did that, and I think one of the things that people don't, when they don't, the perspective that you as a bank, an SBA lender give someone is value, as Andrew said, and that's really one of the things that a buyer, you make a lot of your money on the way in, and that means buying it right. It means buying it at an appropriate price. And the bank helps that because you won't fund beyond what you feel are reasonable values. And that is a real help for an entrepreneur because or someone going into a business, because as Andrew said, there's not a lot of comparable values out there to the general public. So that is one of the things that I think is very helpful. And it's helpful for us as people selling businesses too, because we actually use it with our clients to go, okay, if you're in the SBA size, which some of ours are, then you go, we talk with someone like Lisa and we go, okay, where would this be at? Andrew kind of comes up with the value, comes up with the value we think it is, and he verifies that we're within the right range with someone like Lisa before we even set the asking price or talk about the final price with the seller, because on the other end, we have to facilitate a deal that's going to get done. And that's one of the things that's really,
that's good for everybody. But, you know, at the end of the day, I mean, and that where the bank comes in is it's common sense. And, you know, the bank, you know, businesses generate cash flow, and the cash flow has to support. Now you're going to be levering a company and taking on, you know, a significant debt. You got your monthly nut, you know, the owner understands that, you know, they've built equity into the business. They're not paying debt service anymore, but the person coming in, and it's critical, especially in those first 2 years, that there's enough cash flow to support that. And there's enough cash flow to also pay, you know, the new management, you know, or the new owner to operate the business. And there's enough cash flow also to reinvest back into the business and, you know, have a rainy day fund, you know, so there's a cushion there. So the banks are, of course, conservative. But you get into that realm, then you can, from that, you can come back around and see what really is a fair asking price, which works for both sides, right?
Well, and Lisa can expand on this because she sees this, I'm sure, daily almost. But there are, you know, the biggest reason why deals don't get done, both from a buyer standpoint, seller standpoint, is unrealistic expectations of the seller on the value. And the bank helps to be kind of a conduit between that, because everyone knows as business owners, we let's see, I'm going to use the right words. We think we know it all because we've been business owners forever. You know, you run into that a lot. And they've read, as Jennifer, it's cool, Jennifer, her comments in here, because she used to work for an investment bank. She's talking about, sadly, the only thing many people know about value in businesses is what they saw on Shark Tank, and she says they know no clue on EBITDA and business valuation in reality.
Well, I think, Damon, there was a good example we had yesterday. We had a business owner we're just talking to, and what he because we asked him what he thought
Yeah.
he should sell before. What did he say?
Well, he was thinking it was 14x if it was really, really good. And I was like, wow, that's pretty crazy. And it was like, well, that was a public company. And well, okay.
He saw another company get sold, which was a public.
It was another company got sold for that. It was a public company. Public companies it's a whole different realm from a private company. It's not even, it's like, stock trades like cash. Your value in your company doesn't trade like cash. And that's the main difference. But you will get, if you're going to get 3 or 4 for yours, if you were a public company, you might get 9 or 10 or whatever the number there, but there's a hell of a difference is all I'm trying to say.
That rolls back to understanding a size premium, and companies valued, bigger companies, and I mean big in publicly traded companies are huge, and there's a higher, you get a higher valuation for that.
Yeah.
And this is all, it scales all the way down, and the smaller, the higher the risk, the lower the multiples. But Lisa can talk a little bit about that.
Yeah. And my perspective in our lower middle market, I quite frankly don't care what the multiple is. That's not my concern. My concern is debt service coverage.
Yeah.
So I take cash flow, basically, real simple net income on the tax return plus the add backs that we're all going to decide to agree on.
Yeah.
Minus, $100K for our new owner coming in. That's cash flow. And that needs to cover now. For the last 20, I've always been the more conservative one in our neighborhood, right? I've always wanted 1.5 debt service coverage or higher. SBA, depends on which lender you're working with, maybe 1.1, 1.25. But most of my clients, I've got clients that are trying to grow the company. Really hard to grow the company at a 120 debt service coverage. I know SBA allows it, but you have enough runway to handle a little bit of downside in case that comes up time to time, and then enough to grow the company so you're not just paying me back for 10 years. And I've sort of gravitated toward a 1.5 debt service coverage. And so if you want to pay a higher multiple for bringing in extra equity, or you've structured it with a bigger seller note to close the gap on valuation and debt service. I mean, there's lots of ways to maybe get to the multiple that everyone's comfortable with. But I will tell you, in lower middle market, that's why we're not seeing those 10, 7, 8, even 5 multiples sometimes. We're just not even getting there because of I'm basing it off of cash flow coverage.
So when you explain, can you explain that the debt service ratio you just talked about, or because you in banking, everyone talks about it, but I'll tell you, in the business owner world, 99% of us got no idea what you just said.
Yeah, it's and I'll just keep it real plain. It's the amount of cash flow, and not to confuse that with liquidity or what you actually have in your bank account, but off of the paper. Your tax return, take your tax return, the net income. And then we understand from a small business perspective, you might be, running some discretionary expenses through, through your account, through your tax return. There's a balance of limiting your tax liability, and hey, it's all fair. We get it. So your sell side advisor should be working with you to get a sense of what reasonable add backs are, discretionary add backs. The buyer coming in, we just won't be encountering like charitable contributions, or maybe you've got an extra family member that isn't critical to the business that you're paying for. So we're going to add certain expenses back. So that's your net income plus your add backs. That's your cash flow. That's how much cash flow, excess cash flow you have, minus the debt, minus our debt payment, that's the cash flow you have to cover our debt payment.
Yep.
So cash flow over our debt payment plus the seller debt. If there's a seller note payment in there, we're going to add my annual payment from the senior debt side to the seller debt. That's your annual debt. The cash flow's got to cover that at 1.5 times or better. That's my debt service coverage. Your lender may have a different threshold, but that's my threshold.
So Lisa, let me ask you something too, because we talked about strategics. The strategic buyer. Now, strategic buyer for everybody is not an investor buyer or an individual who's looking to buy a business. A strategic buyer is somebody who's already in a similar type of business that hiring it to grow. Just a little background there. But if a strategic buyer comes in and there's some synergies there, do you take those into account into your LTV calculations, and therefore maybe you can get a higher price or fund it?
Yeah, with strategics, sure, that is one possibility. It depends on what the nature of that strategic acquisition reason is. Are you trying to get extra geography? Are you trying to get a certain revenue stream that you don't have? Do you have concentrations and the acquisition target is going to level that out? It all depends on what the reason for the acquisition is and the that company operations in relation to your operations. But yeah, strategic work on a different level because we can now take into consideration your cash flow in addition to the standalone cash flow of the acquisition. And in those cases, that's why what happens with our individual buyers, especially Andrew and Damon, when you've got a seller and you might have a strategy of marketing it to a strategic or to an individual buyer, your strategics are just going to be able to outbid an individual buyer for the most part. Unless on the buy side, there's something intangible or something about that particular buyer coming in that the seller really, really likes.
Yeah.
And it's not always about price, but generally strategic is going to just from a price standpoint and be able to outbid an individual buyer for one buyer coming in, but it's not always about price.
Yeah, that's exactly. And one
for the most part, we're talking today too about it mostly for the individuals or people who want to buy a business, and how you do that. But you are competing against strategics. In strategics, as sellers, we love strategics. That's the best kind of buyer.
Yeah.
As usually they will pay more if they have a reason to do it. But for the most part, these are brick and mortar or not, block and tackle type companies. There's not, not heavy on intellectual property. Or those kind of things that actually attract a strategic. They're just good companies out there, with good cash flow generating revenue.
Yeah.
They're typically going to sell to, not most of the time get sold to strategic. And those are great companies to buy.
And back real quick on the debt service, those people out there that are considering buying a business, using that debt service calculation when you look at a business is one of the key things that you need to think about when you're buying the business, because cash is king, and it's even more of a king when you're going to buy a business, because that business may look like, oh man, it makes $500,000 a year. I'm going to be fat and happy, right? Until you realize that, okay, now I'm going to chunk out some of that for I've got to pay back myself, someone else, the SBA, whoever, out of that. And then I have to reinvest money in the business. And if you're looking to expand, as Lisa said, with some of the other ones, you need the cash flow for that. And then you want to pay yourself on top of it. And then you got to pay tax, that in your tax situation, you got to consider your tax situation. I can't tell you how many people I talk to when they look at buying a business and think that a $500,000 business is going to be a panacea for them, and realize that when you get to the end, it may not be.
Well, we got the loan to value ratio. It's one thing to make sure that that's in line. And this helps you value, and understand what a good asking price is. But the other aspect of it often forgotten, and it needs to be prepared for, is working capital.
Yes. So
because you're at zero.
Yeah.
If you buy a business, then I think people don't, they forget about this and account for it. That you can't use all your money up to buy the business.
Yeah, because there's two checks you get to write, one to buy it and one then to fund it until the money starts coming in again. Okay, can you explain that a little bit, Lisa, how the SBA can help with that?
Sure, and I would say the working capital conversation has a tendency to be sort of the most awkward, potentially the most contentious. Buyers never know when they should bring it up. They want to at least get an LOI signed or an IOI accepted. And so I think it's just the most awkward of the negotiation, especially for a first-time buyer or any buyer, even strategics. But, and I can't advise as to when you should bring it up, but it definitely needs to be considered. So if the sell side has decided that they're going to keep the accounts receivable and the deal needs to be structured where it's a neutral balance sheet and the working capital, the fuel, is staying with the seller, then the buyer needs to buy that working capital from me. if the buyer isn't buying the working capital from the seller in the price, then it's got to be purchased from me, i.e. term working capital, combination term working capital and line of credit. So it's not free. Working capital is not free. So it, impacts valuation, because now the debt service has to also include the ability to afford line of credit interest and or term working capital principal and interest if I'm building it into the term loan. It depends what industry. It depends what time of year you're buying it. If there's maybe a seasonality aspect, we're going to ask for P&Ls on a monthly basis to get a sense of what each month profit and losses and how much working capital needs to be required to run it on an as-is basis. And then also, if our clients have a growth strategy, then they need the maintenance capital, working capital, but then they also need growth capital. And then we've got to figure out kind of the line of credit. And I would say the thing that often makes it a little bit awkward, and even for you on the sell side advisory, if you've got the first time seller, right? And they don't understand maybe that working capital is necessary to grow it. And also maybe they don't, it's an educational process for both sides of it, I'll say. And they don't necessarily grasp until you bring it up that, the accounts receivable are required to run the machine. So if you're taking that fuel, then your buyer needs to buy it someplace else. And now that debt service is not what you also think it is, because now we're building that into the loan. That was a long-winded way of saying that.
Yeah. No, it's all money you put in.
You're right. It's people avoid it. And I see that it's a deal killer, eventually. So we work with our clients because they don't think about cash flow. They have a different definition of cash flow. They don't, their cash flow understanding sometimes is limited, and it's not important to them because they're not paying the debt service that a buyer can be facing. So especially, you're right, and growth can change, that picture significantly. If you're selling a business that's growing, which is good, you're going to get more money for it. People like businesses that are growing, but it costs money to grow businesses, so we spend time to figure that out. But to answer what you were saying too is buyers too, part of getting ready to buy a business is to, I say, you address the working capital at your first offer.
Yeah.
I want to talk a little bit and shift a little bit away from that and get it out there right away, because it's going to be negotiated and it's going to be paid for by one side or the other, or a combination of both. And it's part of that front offer. But if I don't see that, anything addressed in working capital in the first offer, we're not going forward until it is in most cases. But I know people who do, and usually it really means you're going to go into diligence and work for about 30 or 40 days, and then the deal's going to fall apart.
Yeah. If you don't make that clear right up front, or very early on, you don't know if you're going farther. And from a buyer's standpoint, you got to flush that kind of crap out early, because there is no reason to go a minute longer to try to get a deal done that's going to die.
If you've used all your resources to just buy the business and you don't have enough left for working capital, you can't do it.
Yeah.
That's, and businesses, they do try, but you're overextended. And so dial it back, and so know what you've got to work with. And make sure that you prepare, that you assume that you're going to have working capital in there. But again, I wanted to pivot a little bit to the LOI. The offer, that's the thing that, and this is the thing that I talk to buyers a lot about, is because they're very reluctant to put down an offer and an LOI. And I don't think they really understand that to be successfully buying a business, and time is a big factor, is you need to be able to strike. Do all your homework and be prepared to strike with an offer. Again, I compare that to a competitive real estate market, because, the LOI is best for you because the buyer comes in and it is basically locked in the deal. You may be prepared to put some earnest money in, be prepared to show the seller you're serious and have done your homework and you are going forward. That's how you get an accepted offer. But what does it do for a buyer? Is that now that deal is yours to work on, and they can't sell it to somebody else while we're under an LOI. Maybe we would talk a little bit about that Lisa?
So from my perspective as the lender, we're surprisingly busy. I think that there might be maybe a misconception that, oh, there's no deals getting done. We're actually going to blow through my original goal for the year. So I'm going to actually close more volume than was my original goal, even come September. So it's all about being efficient. And for me, having that LOI in place and accepted, giving both parties time to do their due diligence on one another and the business, and giving me time to work with my client, having that LOI in place really allows me to invest my time into it as well, knowing, and generally there's exclusivity. I mean, I know there's strategies around exclusivity from your sell side, but generally there's exclusivity for the buyer where people have time to do due diligence.
Yeah.
Was that kind of the comment you wanted me to hit?
Yeah.
Yep. Exclusivity, that's important. If people don't understand what that means, is you've presented an offer and it's been accepted by the buyer contingent on everything. Now that the diligence items in your LOI, you need to lay out what are those contingencies. Same as buying a house. We're going to have a home inspection. We're going to have, do this. We're going to have, you're going to have to repair this, something else, all that needs to be laid out in that LOI. Again, it's striking hard and fast, because then that deal is yours. You own it. That's what the benefit is for the buyer.
Yeah.
Because sellers are not going to, they're going to, all these are structured differently. Some are very organized and sort of you've got a timeline. Others are, hey, first person who steps up with an offer that we're good with, it's yours. We're locking it in. And there's so many of them. Again, that's the thing I'm trying to get yourself ready, pre-qualify yourself, make sure your ducks are in a row, and get that offer and lock it up, because there's so many of them that are like, damn, I missed that one.
Yeah.
Because I accepted an LOI last week and we have 4 or 5 more people. And, I'd love to accept their offers, and their offers can come in, higher, but, we're in, this doesn't matter. And this is,
on the LOI, it's pretty simple actually when you look at it, and you can search and find some forms and those kind of things, but it's non-binding. It just lays out the basic terms of the deal. It talks about the contingencies, as Andrew said, that, it's contingent on your diligence getting done to your satisfaction. It's contingent on financing. It's contingent on working out the other details that are unique to the business. And then you lay out the timing for the seller, so they understand that you are prepared. Because if you can say that I'm ready to close this deal within 90 days or whatever the time frame is, based on working with your banker for the financing and everything and what you decided there, that's all relevant to that seller. Because someone that comes in, as Andrew said, and Lisa both, it's not always about the price. It's about, if they're really sensitive to getting out of their, or getting their business sold, before you run into a busy season, or just all these different kind of things. Timing is real important too. Your contingencies are real important too, because if you know that you've got you've worked with an SBA banker, and that, listen, if the cash flow is like this, and I'm in an industry that they're comfortable lending in, and they're comfortable with me in that industry, and the ratios are reasonable, you can then put a little stronger offer in maybe, and get your business done. But as Andrew said, getting locked up exclusive is where you want to go on the businesses that you decide, I got to go on this one.
Successful buyers are decisive and know what they're looking for, and go in and can do it. And that's really an issue too, is that, buyers tend to want to have a lot of comfort before getting an LOI, and that's okay. But sellers can't do that for everybody. I mean, you can't go and do all the things that you do in diligence beforehand, but you need to understand the basics. And again, that's preparing and knowing what you want and what you're looking for. But a good, professional buyers, can make a decision pretty quickly. Is there enough cash flow to support it? Everything else, I know this business well. I've had because we give a lot of information in advance of an LOI to a buyer. But you haven't talked to the business owner, you haven't met the management team, you There's a lot of things you're not going to get to do before you have to be able to strike an offer, but you should have experience in that industry and understand, some sort of background. In a strategic, a professional buyer just is really looking for 5 or 4 main points. Everything else they base on assumptions.
Yeah.
We'll assume that the management team is good. We assume that what they're telling us on the cash flow is what they say it is. Even then, you don't always get that information at that time. Assumptions are important. If these assumptions, that's your contingencies. If that's there, this is my offer, lock it up, be decisive, move forward. My bank will fund this if this is all true. And then diligence is where you work all that out.
Yeah.
And that's what a successful buyer gets.
That's a key point, I think, that I want to re-emphasize, Andrew, is that because the LOI is non-binding and because the LOI is laying all this out, if someone tells you that the cash flow is $1 million to the business, take that as the truth, but verify it in diligence. Make your offer based on the fact that it's true. Don't try to figure that out before you put the LOI in. Get a little bit familiar with the business. Make sure there's no big hairy spots on it that you say this would just turn me away. But assume that stuff is true. Then as you get into diligence, you're going to be able to verify, and that's one of your contingencies. But if you're trying to do this ahead of time, I will tell you that sellers will not typically go down the detailed level to review, because we know that it's too much detail and people will have not looked at it well enough if they want to get into that. It just will not help.
But as sellers, people have to understand, people that have a good businesses get approached about selling all the time. So they can't talk to everybody, and they also get approached by there's good buyers and there's bad buyers. And good buyers are what we're talking about today. Bad buyers are people who have been looking for a business for 5 years and haven't bought one, or just curious, or worse, are competitors who are just nosy.
Yeah.
And whatever. Bad buyers, some of them are with all good intentions, but just don't really have the financial wherewithal to go through a transaction like that. Maybe they're getting supported by their uncle, or something like that. If you're not a principal in this, it's just like I said, if everybody with all good intentions, 20 people who go out to buy a business, one's actually successfully going to get it done. So it's very important to present yourself as a good buyer, a real buyer.
And I don't want bad buyers either.
What's that?
I don't want bad buyers either.
Yeah, exactly.
Well, we're getting close to the end of time. That's a great point, Andrew, because I think that, getting prepared allows you to be a good, informed, strong buyer. And if you got more questions, reach out to one of us here. We'll definitely talk with you about it. But, we're going to let Lisa come up with some final thoughts, but, think about the SBA as a way to leverage your money you've got to buy a bigger business that can actually, give you a good return on your effort, and do that, because it's just, I think it's a smart way to do it.
If you're thinking about buying a business, your first step is go to your banker. I think that's, I want to buy a business and talk with someone like Lisa and go and talk to them about how you get ready to buy a business. That's clutch.
And in that regard, Damon and Andrew, I emailed you our kind of pre-LOI prep work.
Okay.
And say this is the homework. This is the homework for buyers on the buy side. Get this amount, this level, this type of information ready, and then you are in a position to talk intelligently and efficiently with your lending partner.
Cool.
Thank you for inviting me, and thanks for the forum. I appreciated it. It was great.
Awesome. Well, I'll actually going to put those files in the chat here. I just have to download them on my computer. So everyone hang around for a moment after this. We're going to do a little bit of networking. Lisa Forrest, thank you so much for being here today. Lisa Forrest, Live Oak Bank. Look her up on LinkedIn and talk with her about this. She knows what she's talking about. Thanks everyone for being here. Andrew, take us out to networking.
Yeah, let's go.
All right. We're going to drop off and go. Let's talk about it.
All
Thanks.
right.